Hey guys, how's it going? Lewis Harding Investor here and welcome back to my channel. And in today's video, I'm going to be analysing Imperial Brands stock using fundamental analysis. I'll be then using a DCF valuation model to determine the fair value of their stock. Let's get straight into it. So, who are Imperial Brands? So, Imperial Brands plc, formerly known as Imperial Tobacco Group plc, is a British multinational tobacco company headquartered in Bristol, England. It is the world's fourth largest international cigarette company measured by market share after Philip Morris, British American Tobacco and Japan Tobacco. It is the world's largest producer of fine cut tobacco and tobacco papers. Imperial Brands produces over 320 billion cigarettes per year, it has 51 factories worldwide, and its products are sold in 160 countries. They have all sorts of brands such as Davidoff, West, Golden Virginia, Drum, and Rizla, the world's best-selling rolling paper. That's one people probably will know. Imperial Brands is listed on the London Stock Exchange and is a constituent of the FTSE 100 index. Now let's have a look at the sales summary for Imperial Brands, and the sales basically come from tobacco and distribution, the majority from tobacco. I don't know why, but the percentages on this one are wrong for whatever reason. Market screener, there's some sort of bug going on there. But yeah, sales per region. We have a lot of sales in Germany, the UK, France and the US, with other making the majority of the sales. I'm guessing that's everywhere else in the world, wherever they do sell. Not too helpful, that section for this company, but yeah, they do sell stuff worldwide. Now onto the income statement for Imperial Brands, and all of this data has been taken from Macro Trends and it is in US dollars. So let's have a look from 2020 to 2016, so a 5-year period. The revenue has grown very, very slowly. What is it, about just over 2 billion in 5 years? So this company is a stalwart, it is a slow grower. You're not going to get much more growth and inflation with this company. It's not your Tesla kind of growth, so yeah, it is what it is. Net income, anyways, that's increasing as well. So steady away. Net income's increasing, revenue's increasing. Not too bad. What more can you ask for? Now let's have a look at the balance sheet, and the main two figures I look at. Let's have a look at the first one. So long-term debt. So in 2016, so the debt is lower than it was from 2016 by over $4 billion. But from 2017 to 2020, it's actually increased. So yeah, I wonder what's going on there. How come they've taken on a bit of debt in recent times? Then let's have a look at returned earnings. So it's showing an accumulated deficit. Maybe the right figure to have a look at here is the actual shareholder equity, and this is actually decreased over the past 5 years, which is not a good sign really. It might have something to do with the dividends being paid, which will reduce this figure, but that's not a good sign. You want the shareholder equity over time going up, because it shows that the company is making consistent profits and not rinsing its shareholder equity for the dividends. So yeah, let's go on to the next bit and see if it looks any better. Now onto the cash flow statement, and let's have a look at cash flow from operations. So yeah, from 2020 to 2016, it has increased ever so slightly, not by much. And then in 2020, it has increased by a fairly decent amount. You'll see that with tobacco companies that the capex is not very big. They don't really have much capital expenditures, so they usually do have a fair amount of free cash flow to play with. But yeah, it's a bit of a strange one really, because it had a dip in 2017, but it's been increasing since. It's just very stagnant really. You can't really see where the growth is coming from, which is obviously a concern. And then yeah, I like to look at the net long-term debt if there's some figures in there, and it's a bit all over the place really. It shows in some years they are repaying debt and then they are issuing debt, like in 2019 they issued some debt. That might be to do with an acquisition, who knows. But then let's have a look at the dividends. So I like to have a look at the dividends in the cash flow statement, because I want to see this increasing over time. Because what does increasing dividends mean over time? It basically means that it shows they can produce constant free cash flows the vast majority of the time anyway. And yeah, you can see it's increasing bit by bit, so yeah, that's a good sign. Now onto the key financial ratios, and the current ratio is below 1, which isn't a good sign. I think this was the same for British American Tobacco, and it is for other tobacco companies, so it might be like a certain sector, industry, trend, that the current ratio is never above 1. So something to bear in mind. I'd compare it to other tobacco companies to see what the crack is. The long-term debt to capital is a little bit high for my liking. I like to see it below 50%. But then, the gross margins and net margins, they're not fantastic really. They're not that good. We'll go on to that in my analysis in a bit. Return on equity is fairly decent now, so no complaints there. Now onto the genuine impact stats, and having a look at this, it's showing that out of the 3 main sections, so quality, value and momentum, the value section, it's looking fairly decent to be fair. But let's have a look at quality first. So in terms of profitability, it's ranking fairly high in terms of the other companies on the app. Financial strength is looking fairly weak. That's likely to do with the debt and the low liquidity in the business. So having a low current ratio basically just means that you have more current liabilities than current assets, which is, it's obviously not a good thing, and it's going to make it rank less for financial strength alongside the decent amount of long-term debt. Capital allocation, this is probably high due to the amount of dividends they pay out. And then looking at value, it's looking very, very cheap. So the income statement on all basis, so income statement, balance sheet, cash flow, is looking cheap or very cheap. So, and it's showing at 11% free cash flow yield, so that is very, very high. So interesting stuff for sure. So then I've added the historical growth in the bottom left-hand corner, and these aren't showing too bad. The dividends are pretty solid. And I think because of the past year, the revenue and earnings have been decent. So some interesting insights there from Genuine Impact. Now let's have a look at my analysis checklist for Imperial Brands. So the company is listed in London, and the market cap is 21 billion. Current price of £15.79, so let's say £16 to make the rounding easier. I don't like pence, so keep it to pounds, keep it nice and simple. But the PE ratio, 5. Wow, that is very low. And then the earnings yield of 19% based on the recent quarter. So that is mental, really, when you think about it. But let's have a look at my pillars and see what we're looking at. So it's not looking good for this first one, is it? So gross profit margin and net profit margin are pretty poor. Not particularly profitable business, so not something I like to see at all. The return on equity is looking fairly decent. This is probably likely to be because they're paying dividends, and if their shareholder equity is decreasing, yet they're making a lot of profits, that return on equity figure is going to go up. So you've got to look out for stuff like that. So it's making the return on equity look better because there's less equity in the business, but that's because we've paid it all out as dividends. So something to bear in mind. Can be the limitations of return on equity sometimes. So long-term debt to equity ratio, as we saw with the genuine impact, pretty poor really. Not good on the current ratio, not good on long-term debt to equity ratio, and not great. So proven ability to grow, but this is where it does get a bit more positive really. So revenue growth is there, net income growth is there as well. Like I said, shareholder equity growth is down, likely to do with dividends being paid out. But free cash flow growth as well. Not much, but still there. Long-term debt has been repaid over a 5-year period, which is a good sign. Dividend growth and then decrease in share count ever so slightly. Only, I don't know how many shares that. 11,000k. What's that? Like 11 million? I think something like that. So not many really in the grand scheme of things. Good acquisitions, I'd probably say yes. It looks like if you have made some acquisitions, it has worked. You'd have to do a quick Google yourself to see who have acquired. Buy at a fair price. So P ratio of 20. Sorry, what am I on about? P ratio of 5 and a price to free cash flow ratio of 4.5. So let's say 5. So from an earnings and free cash flow basis, it's looking undervalued. And then based on my DCF valuation for 10% return, we're looking at a share price of £33. So from here, we're potentially looking at over 100% gain. We'll have a quick chat about this in a bit. So like I said, let's have a look at my DCF valuation for Imperial Brands. And all these free cash flow figures have come from Market Screener, analyst estimates. So I've discounted them at a rate of 10%, because that's my required rate of return. And yeah, based on even decreasing free cash flow figures, it's showing a fair value of the company of £33. Yeah, interesting stuff. Yeah, it's looking undervalued on an earnings and cash flow basis. If it will get there, we will see. With the business, it looks like the free cash flow is decreasing year on year, so that is why it's probably got a low multiple, and the market is not in favour of this stock at the minute. But yeah, let's have a chat about that and see what my thoughts are on the stock. So what are my thoughts on Imperial Brands? So, as you can probably tell, I'm not overly impressed. Well, from an earnings and cash flow basis, and you can see from the numbers, it's looking undervalued. Like, it's showed 100% gain from here, but this is just screaming a value trap in my opinion, and I'll tell you why. So the market is valuing this company at very, very low multiples, like extremely low, as if it's going to go out of business. As we've seen from the analyst estimates, the free cash flow figure it's looking like it's going to decrease over time, which is it should ring alarm bells. You want that figure to be staying stagnant, or, well, you want it to be going up, to tell you honest. There's always a value to the cash flow, no matter how much it's growing or decreasing. But I just personally think there's better options out there, and there's quite a few tobacco companies which are looking undervalued, such as British American Tobacco, Altria, Philip Morris. Just better businesses, better profit margins. The American ones have more debt, I believe. British American Tobacco, I think, is probably the best one debt-wise. But yeah, I just think there's more superior tobacco businesses than this one. And so this one's got a dividend yield of 9%, which is obviously very, very high. And it's, you wonder, can they keep this up? We'll have to see. Maybe they could prove everybody wrong and it becomes a fantastic pick. And eventually the price reverts to the mean where it should be based on earnings, but who knows? Who really knows? I hope this was useful though, and of course don't just listen to what I say, do your own research, but I hope this was helpful if you are interested in Imperial Brands stock. As always, thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos